welcome to the Property Wealth Podcast. We're so glad you're here with us today. If you're over 40 and looking to build long-term wealth through real estate, you're in the right place.
Absolutely, Sarah. Today, we're diving into a really exciting topic, house hacking with multifamily units. It's a fantastic way to leverage your investment to generate income while living in the property.
Yeah, think about it. You could potentially live for free or even make money while owning your home. Sounds pretty appealing, right?
Definitely. And we'll be covering some practical tips on how to find the right multifamily property, how to finance it, and the key things to consider when managing tenants.
Plus, we'll share some real-life examples from our own experiences. Because, it's one thing to hear about strategies, but actually seeing how they work in practice makes a huge difference.
For sure. And we'll also touch on some common pitfalls to avoid so you can navigate this journey more smoothly.
Exactly. So whether you're a seasoned investor or just starting out, we've got something for you. Let's jump right into it, shall we?
Yes, let's get started. Sarah, one of the big reasons house hacking is so relevant right now, especially for folks over 40, is the looming retirement timeline. People are really starting to think about how they'll support themselves when they stop working.
Absolutely. And with inflation rising, it's not just about saving for retirement anymore, is it? It's about making those savings work harder for you.
Right. Think about it. If you're relying solely on your savings or even a pension, that might not stretch as far as you hoped, especially with living costs going up. House hacking can offer a cushion, a way to generate income while living in a property you own.
I love that. It's like you're living in your investment, right? And the idea of multifamily units is really appealing because you're not just relying on one source of income.
Exactly. I had a client. Let's call him Tom. He bought a duplex a few years ago. Just high five. He lived in one unit and rented out the other. Initially, he thought it would just help cover his mortgage, but it turned out to be a game changer.
Wow, that's amazing. So he basically had someone else helping him pay off his home?
Yes. And as his property value increased, he found himself with this appreciating asset. Plus, he had the rental income coming in. It really eased his worries about retirement. He was able to invest that extra income into a retirement account.
That's a smart move. It's like he's building wealth on multiple fronts.
Definitely. And let's not forget about the emotional side of financial security. For many people, especially those over 40, the thought of retirement can be daunting. Having a steady income stream from a rental can provide peace of mind.
Yeah, it's like a safety net. I read somewhere that a lot of people worry about outliving their savings.
Right, and house hacking with multifamily units can be a solution to that concern. It not only provides income, but it also gives a sense of control over one's financial future.
That's so true. And you've got the added benefit of potentially passing down wealth to your children or family.
Exactly. I know a couple, let's call them Lisa and John. They purchased a 4-unit building. They lived in one unit and rented out the other 3. Over the years, they've been able to pay off the property, and now they're in a position to hand it over to their kids.
So their kids could have a rental property without any initial investment?
Yep, and that's a significant advantage. It's like starting their children off on a solid financial footing, rather than the traditional route of helping them buy their first home.
It's such a powerful legacy to leave behind. But I guess it does require some upfront effort and planning, right?
Absolutely. There's a certain amount of work involved in managing tenants and maintaining the property. But many find that the effort is worth it, especially when they see the long-term benefits.
And it's not just about the numbers either. It's about the lifestyle you can create. Imagine having that extra income and still being able to travel or enjoy hobbies without the constant stress about money.
Right, and more than just financial freedom, it gives you options. If you're not tied down by a mortgage, you might decide to travel for a few months, or even pursue that passion project you've always wanted to start.
And let's talk about market shifts. We've seen some major changes in the real estate landscape recently.
Definitely. With the current economic trends, there's a lot of uncertainty. Multifamily units tend to hold their value well, even in a downturn. People always need a place to live, and rental demand remains steady.
So it's a more resilient investment?
Exactly. You're not just betting on appreciation. You're also banking on cash flow, which is much more stable.
And there's something comforting about that. especially as you're thinking about the next phase of life.
For sure. I remember talking to a woman, let's say her name is Karen. She was apprehensive about investing in real estate late in her career. But once she realized the potential for cash flow and the ability to build wealth, she felt empowered.
That's inspiring. It's like she found a new purpose in this journey.
Yes, and that's what it's all about. Empowerment, security, and creating opportunities for yourself and your loved ones.
And if someone's listening and thinking, this sounds great, but where do I start?
Well, that's where we'll dive into some core strategies. I think understanding the practical steps can help demystify the process.
Absolutely. Let's explore those strategies next.
So let's dive right into some core strategies, yeah? One of the first things I always tell people is to understand the 1% rule. It's a simple way to gauge whether a property is worth pursuing.
Right, and the 1% rule basically says that the monthly rent should be at least 1% of the purchase price, correct?
Exactly. So if you're buying a multifamily unit for, say, $300,000, you'd want to see a monthly rent of at least $3,000. It's a quick filter to help you decide if a property has potential for cash flow.
That makes sense. But what if the property doesn't quite meet that 1% benchmark?
Good question. You can still consider it, especially if the neighborhood is appreciating or if there are other factors at play. Like, for instance, if you think you can add value through renovations.
So you're saying you can create more rental income by improving the property?
Exactly. That's where the 50% rule comes in handy. It's another quick mental math tool that helps you estimate your expenses. You assume that about 50% of your rental income will go towards operating expenses.
So if you're getting that $3,000 in rent, you'd estimate about $1,500 for expenses?
Right, and that leaves you with $1,500 in cash flow. But remember, this is just a rough estimate. You'll want to dig deeper during due diligence.
Got it. And during that due diligence, what should investors specifically focus on?
Well, one essential thing is the cap rate. That's the capitalization rate, which helps you evaluate the potential return on an investment property. You calculate it by taking the net operating income and dividing it by the property's purchase price.
Can you walk us through an example of that?
Sure. Let's say you're looking at a multifamily unit that nets $30,000 a year after all expenses. If the purchase price is $300,000, your cap rate would be, $30,000 divided by $300,000?
Which would be 0.1 or 10%.
Exactly. A 10% cap rate is generally considered a good return. But again, it really depends on the market and your investment strategy.
And that leads into understanding your market, right? Not every area will have the same expectations for cap rates.
Right. Some markets might see 7% as the norm, while others could be much higher. It's essential to research, look at local trends, job growth, and rental demand.
So let's say someone finds a property that meets the 1% rule, has a good cap rate, and is in a promising area. What's next?
They should create a deal evaluation checklist, to keep everything organized and make sure they're not missing anything important.
What kind of items would go on that checklist?
Well, you'd want to include things like the property's condition, the age of major systems like the roof and HVAC, and the quality of tenants if it's already rented. Also, zoning laws, and what future developments might be in the pipeline.
And financing is also a key piece, right?
Absolutely. There are several options, depending on your financial situation. Traditional mortgages, FHA loans, or even commercial loans if the unit count is higher.
What about using an FHA loan for a multifamily unit?
Great option. With an FHA loan, you can put as little as 3.5% down if you're planning to live in one of the units. It's a way to get into the investment with lower upfront costs, which can be a game changer.
But they have to live there for a certain period, right?
Yes, typically you need to occupy the property for at least a year, but that's not a bad trade-off when you think about building equity while also generating rental income.
And what about the importance of property types? Are there specific multifamily units that are better for beginners?
Honestly, I'd recommend starting with duplexes or triplexes. They're often easier to manage and can provide a good balance of cash flow and risk. Plus, having fewer units means less complexity, which is key for someone just starting out.
And what if they're looking at larger buildings?
Larger buildings can be great. but they usually require more experience and capital. You need to be prepared for potentially higher maintenance costs and the complexity of managing more tenants.
So it sounds like building a solid foundation with smaller properties is a smart strategy.
Exactly. And it also gives you the chance to learn the ropes without overwhelming yourself.
Speaking of learning, what are some common pitfalls investors should watch out for when they start house hacking with multifamily units?
Oh, there are quite a few. One major one is underestimating the costs involved. Many new investors focus solely on the mortgage payment and forget about things like property management, maintenance, and vacancies.
Right. It's that 50% rule again.
Exactly. Another pitfall is not properly screening tenants. You really want to ensure you have reliable tenants to minimize headaches down the line.
And you can never be too thorough with that process, huh?
Nope. And lastly, I'd say failing to have a solid exit strategy can be a huge mistake. Always think about your long-term goals and how this investment fits into them.
That's a great point, Mike. It's all about planning for the future while navigating the present.
Absolutely, Sarah. It's a journey, and being prepared is key to making it a successful one. So, Sarah, one of the biggest pitfalls I see with house hacking, especially with multifamily units, is over-leveraging. It's like people get so excited about the potential cash flow that they stretch their finances too thin.
Right. I can totally see that. They might think, oh, I can just take out a bigger loan. But then, what happens if things don't go as planned?
Exactly. I once worked with a couple who bought a fourplex, thinking they could manage it easily. They put down a minimal amount, just to get in the game, right? But then, when the roof started leaking, and they had to deal with unexpected repairs, they were really caught off guard.
Wow, that's tough. I mean, those unexpected costs can really add up quickly. It's not just the mortgage, right? There are so many moving parts.
Absolutely. And that's where it ties into cash flow. A lot of new investors underestimate how important it is to have a solid cash flow buffer. They might see their rent checks coming in and think they're set, but then they forget about maintenance costs, property management fees, or even vacancy periods.
Yeah, and those vacancies can be a real killer. I've heard stories of people who end up with units sitting empty for months, and they're still responsible for the mortgage.
That's right. And it's not just the vacancies. It's also about the tenant quality. I mean, bad tenants can really destroy your investment.
So true. What's been your experience with that?
Well, I had a client who was so eager to fill their multifamily unit that they didn't do the proper screening. They just wanted someone in there. They ended up with tenants who, didn't pay rent on time, had frequent noise complaints, and caused damage to the property. It turned into a nightmare.
Oh no, that sounds awful. So what should someone look for when screening tenants?
Great question. It's all about having a solid application process. You want to check references, employment history, and credit scores, and really trust your gut instinct. If something feels off, it probably is.
That makes a lot of sense. And I can imagine that ignoring cash flow can lead to some serious stress down the line.
Yeah, and another common mistake is trying to time the market. People often think they can wait for the perfect moment to buy. But, the reality is waiting can lead to missed opportunities.
Right, the market's always changing. It's like, if you wait for the perfect time, you might just miss out on a great deal.
Exactly. I had a friend who kept waiting for prices to drop. And by the time he decided to pull the trigger, prices had gone up significantly.
Ouch. That must have been frustrating for him.
For sure. And then there are hidden costs that people often overlook. Like, when you're budgeting for a property, you have to consider things like property taxes, insurance, and even homeowners association fees if they apply.
Yes. I think that's a huge one. Sometimes people think they can just calculate their mortgage and rent, but there's so much more involved.
Absolutely. I remember another case where someone bought a multifamily unit thinking it was a steal. But then, once they got in, they found out that the property taxes were much higher than they anticipated, and there were also repairs that needed to be done immediately.
That sounds like a classic case of not doing enough due diligence.
Exactly. And it's so important to do thorough research beforehand. I always advise people to do a complete inspection and maybe even bring in a professional inspector. It can save you a lot of heartache down the road.
And those inspections can uncover issues that could be costly later, right?
Yes, definitely. It's better to know upfront than to deal with surprises later that can derail your cash flow.
So what are some red flags to look for when considering a multifamily property?
Well, if you see a property that's been on the market for a long time, that can be a warning sign. You also want to watch for properties that seem too good to be true, or if the seller is unwilling to negotiate. And always check the rental history of the units.
That's great advice. So if someone finds themselves in a tough spot, like with bad tenants or unexpected costs, what can they do to recover?
The first step is to reassess the situation. Take a deep breath and look at your options. If it's bad tenants, you might need to consider eviction, but always follow the legal process. And if it's cash flow issues, you can look into ways to reduce expenses, or even consider a temporary rent increase, if the market allows for that.
That makes sense. So staying proactive is key, right?
Exactly. And also, don't hesitate to seek professional help. Whether it's a property manager, an accountant, or a real estate advisor, sometimes a fresh perspective can really help you see the bigger picture.
Such great insights, Mike. It really emphasizes the importance of planning and due diligence in real estate investing.
For sure. And remember, it's all about building a sustainable strategy. Real estate is a long game. So you want to make sure you're setting yourself up for success, not just in the short term, but for the years to come.
Absolutely. And as we wrap up this segment, it's clear that being informed and mindful can help avoid these common pitfalls.
Definitely. And with that knowledge, you can make better decisions that will serve you well in the long run.
Great points, Mike. Now let's talk about what steps listeners can take next.
So let's dive into some immediate steps that anyone listening can take right now.
Yeah, I think that's really important. What's the first thing people should do?
Well, a great starting point is to educate yourself. I always recommend checking out some solid books on real estate investing. A classic is Rich Dad, Poor Dad by Robert Kiyosaki. It really lays a foundation for understanding assets and liabilities, which is crucial for house hacking.
Oh, I love that one. It's such a good read. What about podcasts? Any favorites?
Absolutely. BiggerPockets podcast is fantastic. They cover a variety of topics and often have guests who share their experiences, which can be super relatable.
I've heard of that one. And what about tools? I know there are some apps that can really help with analyzing properties.
For sure. One of my top recommendations is the BiggerPockets calculator. It's really user-friendly and helps you run the numbers on potential investments. You can see cash flow, ROI, all that good stuff.
Nice. And if someone's looking at rental prices, what do you suggest?
Rentometer is a great tool for that. It allows you to quickly check what similar units in the area are renting for. Super handy when you're trying to set your own rental price.
That's great. What else can people do right away?
Getting familiar with local MLS access is key. If you can get in touch with a real estate agent, they can give you access to the MLS. It's a treasure trove of listings and market data.
Right, and understanding the market is so important. What about habits? Any small steps people can start with?
Definitely. I suggest analyzing one deal per week. Just pick a property, run the numbers, and see if it makes sense as a potential investment. It's a great way to build your skills without feeling overwhelmed.
That sounds manageable. And what if someone wants to connect with others who are also interested in real estate?
Joining a local real estate meetup can be invaluable. It's a chance to network, learn from others, and share experiences. Plus, it can be motivating to be around like-minded people.
I can see how that would help keep you inspired. What else?
You might also look into local real estate investment clubs. They often have speakers, workshops, and other resources that can deepen your understanding of the market.
That sounds like a good way to stay engaged. Are there any specific platforms people should look into?
Yeah, there are a few out there, like meetup.com for finding local groups, or even Facebook groups focused on real estate investing. Just search for your area, and you'll likely find some active communities.
That's super helpful. And I assume keeping track of your progress is important too?
Absolutely. I suggest using a simple spreadsheet to keep notes on the properties you're analyzing, your thoughts, and any lessons learned. It'll help you see your growth over time.
That's a great idea. And what about mindset? Anything to keep in mind as they start this journey?
Well, it's all about starting where you are. Don't feel like you need to have everything figured out right away. Just take small, consistent steps and celebrate those little victories.
That's so important. It can be easy to get overwhelmed, but focusing on progress makes it more manageable.
Exactly. And remember, even seasoned investors started somewhere. Just keep learning and adapting.
For sure. So with all these tools and steps in hand, it really feels like listeners are equipped to take action.
Definitely. And the journey doesn't have to be rushed. Take your time, absorb the information, and come back to it as you grow.
That's such a reassuring way to look at it. It's about building a foundation for long-term success.
Right. And as you get more comfortable, you can start diving deeper into more advanced strategies. The key is to keep moving forward at your own pace.
So those are some practical first steps. Now let's bring this all together.
Well, Sarah, it's been quite a journey through the world of house hacking and multifamily units today.
Absolutely, Mike. I think if there's one thing we've really emphasized, it's that house hacking can be a fantastic strategy for those looking to build wealth, especially for listeners over 40.
Right, and the first key takeaway is definitely the importance of location. Finding a property in a good area can make all the difference when it comes to attracting tenants and ensuring long-term appreciation.
For sure. And then there's the financial aspect. You know, leveraging the rental income to cover your mortgage can really ease financial pressure. It's like having your tenants help pay for your investment.
Exactly. And let's not forget about the hands-on experience. Managing a multifamily unit can teach you valuable skills. You learn about maintenance, tenant relations, and even budgeting.
That's a great point, Mike. And it can be really empowering. It's not just about the money. It's about taking control of your financial future.
Absolutely. And one last thing to highlight is the potential for long-term wealth building. As property values rise and your mortgage gets paid down, you're building equity. That's a powerful tool for future investments.
It really is. So for everyone listening, think about how house hacking could fit into your strategy. It's a practical way to start investing in real estate and build a solid financial foundation.
And if you enjoyed today's episode, we'd love for you to like, subscribe, and share your biggest takeaway or question in the comments. Also, if you know someone over 40 who wants to dive into property investing, send this episode their way.
Definitely. And next time we'll be diving into the duplex and triplex investing guide, so you won't want to miss that.
We hope you found this helpful. And as always, remember, building wealth through real estate is a journey, not a sprint.
Take care, everyone. We'll see you next time.